Welcome to our podcast, Michelle and Stacey, all things small business.
We hope you enjoy this episode and please visit our website, michelleandstacey.com.au.
That's MICHELLEANDSTACEY.com.au. We would love to hear from you.
Welcome to episode 6 with Michelle and Stacey, talking all things small business. Today, as part of our series on selling your business, we are talking about small business CGT concessions. Now, before you ask what CGT concessions are, we're talking about capital gains tax concessions. We are joined by Robyn Jacobson. She is a senior advocate with the Tax Institute in Melbourne. Robyn has more than 3 decades in the profession and more than 20 years guiding the profession in her various roles as a professional tax trainer. Robyn is an avid advocate, social media commentator, columnist, blogger, webcaster, presenter, and the host of the Tax Institute's Tax Vibe podcast. She's also frequently quoted in the media. Now, let me tell you how I met Robyn. So I met her in her previous role as a tax trainer. Now, I've got to say, I have never met someone more passionate about tax than Robyn.
That's right. I mean, she's fantastic. I met Robyn, quite a few years ago, just through our tax connect, like our tax people that we go and see and talk to all together. And she's like a walking tax machine. So if you have any questions, you can always ask her. But that's not why we asked her on the show today, because we're talking about small business. We don't need to bore you with all the real details. That's for your accountant to work out. But the reason we've asked Robyn is because she's actually had her own business in a past life, ran her own small business, had employees, knows exactly what it's like to run a business, and then she sold it. So she's perfect to come on for this. But she's going to talk to us today about the small business capital gains tax concessions.
Great to be with you both.
Thank you.
That's great. Well, what do we want to cover today?
Well, I think, Robyn, maybe you could start and just talk about what is a capital gains tax asset, right? So, and again, in the context of, selling your small business, because people here, we're talking, through our series, we're talking about all the different stages, and we're encouraging people to go and talk to their tax advisor early on to understand that they can do it. Well, when I say do it, if you are a small business, you can potentially get the sale of the business tax-free, and that would be fantastic. So Robyn's going to guide us through today on how to do that.
But just to pause on that for a moment, if we can. Did you just say we could do that tax-free? There's a way possibly to do that tax-free.
Yes.
Oh, we're in for a good one.
Yeah. So Robyn, can you take this through, we're talking capital gains, and what is a capital gain asset, and what's the difference between that and what we call revenue? So in your normal business, you've got your profit and loss, which is based on revenue, but a capital item you can't write that all off at once. So a capital item could be something like a car, which is normal, or your business actually is a capital item or a capital asset. So talk us through.
1985.
Yeah.
Because that's where this journey begins. And it was 1985, 20 September to be precise, when the then Labor government under Bob Hawke and Paul Keating introduced for the first time in Australia's history a capital gains tax. And very briefly, the reason it came in is you've already talked about revenue. So when you make sales in your business, and whether you're providing services or you're selling goods, you have sales. And that is taxable and goes into your taxable income. But there were people making really good money, good profit, from selling capital assets, typically property and shares, so say listed shares on the share market. And back pre-85, this was all tax-free. And so the capital gains tax was brought in to say, hold on, if you're going to be making a profit out of selling capital assets, we're actually going to tax that. So our starting point is we have a capital gains tax, which has been in place since 1985. So we're coming up to, it's the 40th year this year.
Yeah.
Gosh, the time does go by quickly. And what many people may not appreciate is we don't actually have a separate capital gains tax. So people know we have a stamp duty, which is state-based, and we have an income tax, and we have a goods and services tax, and we have a fringe benefits tax, but we don't actually have a capital gains tax. Instead, what happens is you work out the capital gain you've made, then you work out how much of that gain is taxable, and that taxable amount simply goes into your other assessable income. And then it gets taxed at whatever tax rate you pay on your income.
So let's really dumb it down here. So let's say I bought a house and I don't live in it. It's an investment property and I bought it for, I don't know, dollars quite a few years ago. And I've just sold it yesterday for $500,000. So Robyn, take us through what is the capital gain on that?
All right. So you've got an investment property and it was bought post 1985. Your cost base, as we call it, what you paid for the property is $200,000. And you've sold it for $500,000. So generally what we then do is say, have you held that asset for at least 12 months? And we've got to assume, yes, you have. You might have held it for 5 or 10 or 15 years, in which case you've got a capital gain of $300,000, being the $500,000 of proceeds, the sale price, less the $200,000 cost base, but you then get to discount by 50% that capital gain.
If you own it individually.
But if you own it individually and not in a company.
Yeah, we're going to pause this a bit here because this is can get a bit complex. So depending on which entity owns that asset, so if you've got a company, that's a different story, but here we're talking individually. We're not going to go into detail here, but just to kind of clarify that.
So you'd have your gain of $300,000, you'd discount it by half. So $150,000 would go into your taxable income, and then you'd pay tax on your tax rate.
Yeah. So if your income's only if it was just the capital gain of 150, you just pay tax whatever the tax rate is on 150.
Now, keeping that simple because there are other costs that can get factored in, but for that. So let's bring this back into a business context. You've talked about an investment property in your own name. It may be that you're running a business as a sole trader in your own name, but you might have sold your business property, your commercial property that you run your premises from. And that would be what we call a CGT asset. So it's an asset that is subject to capital gains tax. If we go into whether it be a sole trader, but you could also be in a company or operating through a trust, you have the business, and the business becomes a CGT asset. Now, to break that down, you'll have a business made up of depreciating assets, your plant, your equipment, your cars, your utes, other vans and things.
And just to stop there, we're talking about you can't just write off the whole cost of the car up front.
That's right.
You write it off over a period of time, and that's called the depreciation part of it. So that's a depreciating asset. So you're not writing off all at once, you're writing it off over a number of years.
And then when you sell plant, equipment, vans, delivery trucks, then you work out an adjustment when you sell it, but it's done through the depreciation rules.
Yeah. So we're not going to cover that.
So we're not going to cover that.
No.
We're not going to cover stock because even though stock is a business asset, again, it's on revenue account. You buy and sell the stock and it goes through your profit and loss. So the typical assets we're talking about today when it comes to selling your business will be what we call goodwill. And that's essentially the price above the value of your assets that someone is prepared to pay to buy your business.
So I've started the business by myself, say. I haven't got any goodwill. I started it from scratch. So the cost of that business is zero.
Yes.
I sell it to you for $1 million.
Yes.
So my capital gain is $1 million.
That's right.
Yeah.
So that could be one CGT asset.
Yeah.
Goodwill.
Which is goodwill.
Which is goodwill.
And then also I own my own property that I work out of.
Correct.
And I'm going to retire, so I'm going to sell that as well. So I bought that, say, for $1 million and I sell that for $2 million. So again, I've got another $1 million.
Correct.
Potentially that.
Now, we all try to make capital gains on our assets that we buy. You don't go out deliberately to make a loss, but sometimes you might make a loss. The market might go down from when you buy something. So in that case, we're about to get into the small business CGT concessions, but we don't need to worry about any discounts or concessions when it comes to a loss because there's no gain there. But losses can't just be claimed. They can't be applied against all your other income. You can only reduce capital gains by the capital losses. So in other words, capital losses get carried forward unless you can apply them against a capital gain.
So just to also clarify, you're talking about small business capital gains tax concessions. So there is a special law for small businesses who sell capital assets in certain circumstances, which we were talking about selling your business and the goodwill and selling the property that you run the business out of, you can get these small business capital gains tax concessions. What are they?
Now, again, they've been around in one form or another since 1985. But the modern day concessions, as I'll call them, have been around since 1999. Now, there are 4 of them. And I do need to go through the names of them and explain what they do because they're all different. But essentially, if you meet what are called basic conditions, and it's not a great word because these conditions are anything but basic, but they are called the basic conditions, and any taxpayer who wants to apply the concessions to disregard or reduce the capital gain they've made from selling off their business goodwill or, say, the commercial property that they run their business from, they need to satisfy these conditions. There might also be additional conditions within the 4 concessions, but we'll get to that. So broadly, the idea is we have a 15-year exemption. Now, this means you've held the asset in your business for at least 15 years.
So I run my business for at least 15 years.
Run your business for at least 15 years.
15 years ago.
Now, it could be that it's a company or a trust that owns the property, and it would have had to have owned the property for at least 15 years or run the business for that long to have the goodwill exist.
Yeah, so the business doesn't have to own that property itself in its own name. It can be owned by something else, like another trust potentially, and it still gets the capital gains tax concession.
It is possible. It becomes, again, more complex. So the concessions are easiest to apply when it's really vanilla. So you've got a sole trader, or let's say you've got a mum and dad business and they own 50% each of the company or 50% each of the unit trust that they're operating the business through, and the assets are owned directly in that business. There is a circumstance where, let's say you are running the business through a company, but you might like to place the commercial premises into a related trust.
Yeah, you wouldn't have them in the same. And again, you need to come and talk to your tax person.
Yes.
That you definitely wouldn't have the assets sitting in the same entity as the business.
Correct. And of course, none of what we're saying is specific advice for anyone in particular. This is all just general information. But often people will structure their affairs so they place their property in one entity, say a trust, and they put their business operations into a company. Once those 2 entities are connected with each other, and that's defined in the tax law, then yes, it is possible you could still get the concessions on the sale of that property.
Which is, we're talking the tax-free concession, or potentially tax-free, or very much reduced.
Yes.
So just go back to the 15-year exemption. So that's the first one.
So you need to have held the property for at least 15 years. Yep. And there's also an important condition. You must be retiring.
So that's going to knock a lot of people out. So if you're like 35 and you've run the business since you were 20, it's probably unlikely you're going to retire at 35.
Look, unless you're selling it off to one of these enormous big multinationals.
Well, then you're not going to be, you wouldn't
be eligible anyway.
Okay.
So yes, we're generally talking older people who are closer to retirement who are legitimately retired.
Yeah.
You don't have to retire literally on the day you sell it, but it must relate to your retirement. And this is the best concession to get, because if you qualify for this one, coming back to your point, Stacey, it is tax-free.
So good.
Okay.
Although Stacey's probably a little bit young yet to be.
Oh, you never know. You don't know how old I really
my
am.
age.
Now, if you don't qualify for the 15-year exemption, then we're looking at the other 3 concessions. So the next one we're going to talk about is called the 50% reduction. And this should not be confused with the 50% general CGT discount. So let's run some really basic numbers. Let's say you got a capital gain of $100,000. So this is literally the proceeds less the cost of what you're selling. So you've got a $100,000 capital gain and you've held that asset for more than 12 months. So we're eligible, because we're not a company, for the 50% general discount.
So it brings it down to 50.
Brings it down to 50,000. If we are eligible for the small business CGT concessions, and in particular, the 50% reduction,
you can do another 50%.
Another 50%. Now, it doesn't mean the balance of the 50%. It means another 50%. So correct, down to 25.
Yeah.
So, but the combination of the CGT discount and the 50% reduction wipe out 75% of the capital gain.
Yeah.
That's so good.
It's huge.
Even if we don't get all the way.
And that 25% could actually be eligible perhaps for another concession, or you just pay tax on that quarter and that goes into your income.
And the other concession is?
Retirement exemption. Now,
and this is the weirdest one because you don't actually retire.
It's almost like in the name.
Yeah, it's weird.
So 15-year exemption, you do have to retire. The retirement exemption, you don't have to retire. But the idea behind this one is you can disregard a capital gain up to $500,000 over your lifetime, and then you can put the amount into super. Now, the rules are this. If you're under 55 years of age, when you choose this concession, which is generally when you lodge your tax return, you have to put it into super. If you're over 55, you have a choice. You can either put it into super if you want to, or you can take the cash and run, and that amount up to $500,000 is still tax-free. Let's go back to those other concessions. So we've got the 50% discount and then the 50% reduction. If you can get up to $500,000 through the retirement exemption tax-free, you could have up to $2 million of capital gain that could be completely tax-free. But when it goes into super, is it taxed in the super fund? And if you do it correctly, and you've got to make sure the documentation's all correct and the timing is right and the dollar amounts are correct, and you do need to seek advice getting all this correct, then the amount is not subject to tax when it goes into the super fund. So,
Okay. What about if you're 53?
okay, if we were just looking at the retirement exemption by itself, you're under 55. So if you're going to use the retirement exemption, you would have to put the money into super. But we could choose not to use the retirement exemption.
Yeah.
And we can choose the fourth concession, which is called the replacement asset rollover. And with this particular concession, you choose it and you can defer the taxation of your capital gain for 2 years.
Yeah.
And what this means is, let's say you are 53, you could choose the retirement exemption and then wait till you're over 55 and then use the retirement exemption to disregard the amount that becomes taxable. But by that time, you're no longer subject to the rule that says it has to go into super.
Yeah. And then at 55, you can then do the retirement exemption, and then that's tax-free at that point in time.
Now, interestingly, with this replacement asset rollover, we talk about 2 years, and that is correct. You can defer it for 2 years. But if you're actually going to buy a replacement asset, and this has to be an asset for your business, it can't just be any asset, there's actually a 3-year period. You've got a year before you sell the asset and 2 years after, a total of 3 years. And if indeed you do not buy a replacement asset by the end of that 3-year period, the 2 years following the capital gain, then it comes home to roost.
Yeah.
Unless you choose the retirement exemption and you disregard up to $500,000.
And by that, you mean then you've got to declare that if you haven't utilised that and you haven't utilised the retirement exemption, that's the point you have to pay tax.
Correct. You declare it to the ATO in your next tax return and say, I didn't actually buy a replacement asset, so the capital gain has now come home.
Crystallised.
It's crystallised. Yeah. But I might buy a replacement business asset. I might buy another business, in which case I can roll over the capital gain that I made from the first sale, and I can actually keep doing this again and again and again.
Beautiful.
So in terms of eligibility, there are some core requirements. Very broadly, your business must be worth less than $6 million, but that includes certain assets that you own as well. Sole trader, it's all in your own name anyway. But if you're running your business through a company or a trust, then that entity has to be worth less than $6 million, but so do certain related entities and so do certain assets of yours. But you don't count your home, you don't count superannuation, you don't count life insurance. So they're just some of the assets that we exclude.
So it's like investment properties, or any other businesses you might have.
That's right.
Yeah. Share portfolio.
And the idea of those grouping rules is that, let's say I'm worth $10 million, I can't break myself up into little bits to say, oh, I'm worth $6 million just here. You've got to group certain assets or entities together and working that out. So it's an integrity rule to stop people getting eligible when they're not truly worth less than $6 million. The alternative is your turnover is less than $2 million.
With this business turnover. That one business turnover.
Well, again, we've got some aggregation rules. So we have to be grouped with certain other related entities. But if your business, say, is worth $10 million in assets, but you only turn over $1.5 million, you can still be eligible. Alternatively, you might have a $3 million turnover, but your assets are only worth $5 million, in which case, again, you're eligible. So those tests can take quite a bit of working through to determine if you're eligible. You also need to establish that the asset you're selling is what's called an active asset. So we have names for everything in the tax law. And an active asset means
it goes to the gym?
It's fit and healthy? No. It means it's used in the carry on of your business. So once again, we've talked about commercial property that's used in your business. Goodwill, it's what we call an intangible asset. You don't go out and purchase goodwill off a shelf, but it's still considered an active asset. But things like investments are passive. They're not active assets. So certain assets are passive and investment assets, and they would not be actives. The asset you're selling has to be an active asset. Also, if you do operate your business through a company or a trust, there are rather complicated rules. Basically, you need to have someone involved in the business who has at least a 20% ownership of that business. And that's just to make sure that we're tracing it through to a human being who controls at least a 20% stake. Otherwise, I don't want to be selling shares in a listed company and I've only got a 1,000% stake.
So look, it does get pretty complex, and we don't really want to go into any more detail than that. But it's more this is really just to give you a flavour. But I think the majority of small business owners probably aren't really interested in all the detail, and that's really left to your tax advisor to take you through whether you qualify or not, and let them to work that out for you. But this is just trying to give you an understanding. It is a very complex area. You can't learn to it by yourself. So you're going to need some help.
You also can't just do it off the back of an envelope. So sometimes someone will go into their accountant or their tax advisor and say, oh, look, can you just let me know if I qualify? And it's not a 5-minute exercise.
No. There's no ballpark, am I in the ballpark? We can't answer that question either.
You have to sit down and go through the steps.
Yeah.
And until you go through every step and then you come out the other end, that's the point at which you as advisors can say, yes, you qualify, or no, you don't. And yes, the reality is it could go one of two ways. You say to your client, yes, you qualify. Great, we can apply the concessions, but we still need to charge you for the time we've spent in establishing that. And the response could be, but we're a small business, we knew we were eligible. Or you could go and do the work and even worse, tell your client that they're not eligible, but can you charge your client for the work and the time that you've spent in establishing that the client's not eligible?
And the other thing is clients sometimes are thinking about selling, but haven't really decided that they're going to do it yet. And so they may come and say, oh, would I be eligible? How much roughly is this going to cost? Or roughly what's my business worth? And this is things that we've covered in some previous episodes. But as you rightly said, Robyn, you don't know until you actually test. And if you test before they're actually ready to sell, the test that you do today based on a indicative figure that they think they might get may kind of show that they're eligible, but turnover could go up in 12 months.
Absolutely correct.
And so when they do sell in 12 months' time, and then
there might be a property boom and their outside assets go up and, is over the $6 million mark. So
you might also have a client who comes into you just putting their toe in the water saying, oh, what would happen if I decided to sell my business? And you go through the exercise and you say to them, yes, you'd be eligible, but these are the steps. And they come back 9 months later and say, actually, I do want to sell, but I've had someone offer to buy the shares in my company as opposed to buying the business. And that becomes a totally different calculation. So you've got to go through our whole exercise again.
Yeah.
It is very complex. Like a lot of time now when I have my clients, I usually actually, even though I can advise on this, and particularly if there's a trust or something like that involved, I will usually also engage a good lawyer who understands these concessions, because it's not just the accounting side. It's whether, someone has to read through the trust deed. They have to go through all these different steps. It's actually very complex. So usually you need both your accountant and your lawyer to go through to see whether you qualify.
And can it go wrong? It can. And we've seen stories, we've seen cases where people applied the concessions and then the ATO, the tax office, had a look at it and decided that they weren't eligible.
Give us a simple
Let's hear a
example.
war story.
There are some more stories. Sometimes people just get the numbers wrong. Now, it could come down to valuations, which it's a feature of these particular rules that it's based on a value of $6 million of assets. Now, turnover you can generally measure more readily because you've got the sales coming through the door and you know what the business turnover is. But a valuation of an asset can be very subjective, particularly with perhaps more diverse assets or unusual type assets. So if people are placing a lower value on their assets and the commissioner thinks a higher value is more appropriate, then you can get into a difference of opinion as to what the correct value is. And we have seen cases go to court and to the tribunal where, unfortunately, people did put too low a valuation on their assets and it turned out they weren't eligible. And that $6 million threshold is black and white. You don't get a little bit of the concession if you're just a little bit over. If you're over 6 mil, you're out. Another example is goodwill. Sometimes people forget about internally generated goodwill. which is where it builds up by you running the business. You haven't purchased the business or bought the goodwill from someone else. Now, accounting standards, and it's a long time since I've looked at those, they generally do not record goodwill on the balance sheet
No.
where it's internally generated. But it doesn't mean for tax purposes, it's not a value that needs to be considered when arriving at the $6 million threshold. So sometimes that can be overlooked. Timing. So you've got to make sure that if something has to be done by a particular date, so you've got year-end dates, you've got lodgement dates, you've got periods like 30 days or whatever following those dates. 1 week is another example. So the law tells you what you need to do by certain times. If you do things outside those times, you don't qualify. It's too late to go back and do things. Another one is written documentation. Now, I call this the really non-sexy part of tax, where filling out documentation and signing resolutions and agreements and more broadly in tax, keeping your logbooks and things. It's really, really important to get this right, but people don't like keeping records. And if you don't get your documentation right, if you don't make the declarations in the right way, in the right capacity, what do I mean by that? I could be the trustee of my trust and I could sign a declaration or make a choice that I'm going to do something and apply these concessions. But there was actually a case where the two trustees and a wife signed off this choice, but they did it in their own personal capacity.
Pretty amazing.
So they wrote it off as, they wrote the document, signed the document as Robyn, not as Robyn as trustee for the Robyn Trust.
That's
and
a bit rough. But that's probably why you need a lawyer.
It
to help
is.
to
It
do
might
that
be rough,
calculation.
but when the law says you've got to do things and that choice wasn't made by the right taxpayer, this is when it can come unstuck.
And then this is why getting advice from appropriate people at the appropriate time is important.
Absolutely.
And make sure that the people you're getting the advice for are equipped to give you that advice. Like it's not your mate at the barbecue.
No.
And do not rely on barbecue feedback or pub syndrome, which is where I describe the information that people attain through chatting to others in social arenas. It's really important to get your advice from a registered tax professional.
So I think that's given us a pretty good overview, very quick, and it's probably a little bit too much. So maybe you need to listen to this a couple of times to really get it, or just talk to your accountant if you're thinking about it. But I can't emphasize enough, and I think all of us would say the same, is when you're going to sell your business, this is something that you need to start thinking of, like hopefully years ahead, because you really want to start to plan for it. So you don't just go down all the track, I've got a buyer, here you go, come and give me the advice. You might be kicked out if you have pre-planned for the last couple of years on how you could obtain this. And, you know, it could be a matter of $100,000 on those valuations, and the timing and whatever you could have, you know, you might miss out.
Also important to mention, we have anti-avoidance rules in the tax law. And let's say, Stacey, you had a client who came in and they said, we want to apply concessions or we want to get the best tax outcome when we sell our business. And you look at their structure and you realise the way they are structured actually won't optimise the concessions, or they may not even be eligible, depending on how they're structured. If you then restructured them in order to make them eligible, there could be a problem under these avoidance rules. So these rules are basically saying if you've restructured your affairs, if you've gone into an arrangement, if you've done something in order to take advantage of a tax concession or a tax benefit, then those anti-avoidance rules can apply. So it's not the sort of thing where the client says, oh, that's easy, Stacey, just rearrange our structure and make it work and we'll come in next week and it's all good, because there could be some real concern about those anti-avoidance rules applying.
That's really important, like for clients to be aware of that. So, you know, restructures and things like that often happen not for tax reasons, but for asset protection and those sorts of reasons, or for commercial reasons, so that they don't want assets in one entity and the trading to happen from the same entity, which was something we were touching on earlier in this episode.
That's right.
So there are reasons why restructures can happen, but you're 100% right, not just for the purpose of getting
tax outcome.
Yeah.
And let's take it back a step. This whole series is talking about selling a business, but sometimes structuring a business in the right way when it is set up at the outset
That's the best time.
gives you the best way of enabling the concessions to be applied at the end. So in other words, if you contemplate how you're going to exit the business when you're setting it up, then you're not going to have problems with these anti-avoidance rules because you haven't restructured anything.
No, that's right. Although things do change and things change along the way. So the advice you gave 5 years ago might be totally different today because something's happened, you know, along the way that you can't you would have known.
Thank you so much, Robyn, for joining us. I've got to say, I never thought when we met years ago that this might be something that we did one day, but I've very much enjoyed this, and thank you for joining us.
So I thank you.
No, well, thank you. And again, I appreciate it. And as I've said, we're very lucky that we've got Robyn, not only as like a colleague, but she's our friend, and she is a tax guru, but she's practical, and you can understand what she's saying, which is really important because it can get very overwhelmed and it's very complex. But it's nice to be able to put it into simplistic words and try and get people, well, me to understand the most basic thing. So thanks very much, Robyn. Appreciate it.
Thank you.
Well, thank you for tuning in today to listen to Michelle and Stacey and our guest Robyn. And we look forward to putting out some more episodes for you in this series of selling your business.
Bye.
Bye.
Thank you for listening to today's episode. We hope you found it informative and useful. We would like to clarify that this podcast is for educational purposes only. The conversations are of a general nature and do not qualify or constitute as financial or tax advice. The views and opinions expressed by the hosts and guests are their own and do not reflect any official stance. We make no guarantees about the accuracy, reliability, or completeness of the information presented and are not liable for any losses or damages arising from its use. We recommend you seek the advice of your own legal, financial, or other licensed professional before making any decisions based on the information provided in this podcast. We hope you enjoyed today's episode and tune in again soon to listen to further episodes.